Okay, welcome everybody to another Pepperstone Learn It Live webinar. Today we're going to be going through advanced intraday trading strategies using EMAs and price action. My name's Thomas Atkinson. As always, I'm joined by Tyra Annabella from FX Evolution.
Hi everyone. Looking forward to tonight's webinar. We're going to try and isolate some opportunities in the market using the things that we're going to teach, so it should be a good one.
So just before we get started tonight in the webinar, we'd like to go over a quick risk warning. Obviously, the information provided in these videos has been produced by third parties and does not reflect the opinion of Pepperstone, and the information has been provided without any alteration or verification. It's also important that this is general advice only, and that you seek financial advice before making any decisions, if necessary. So what we're going to be covering today. So like last week when we tried to get most of this stuff covered, we're going to deep dive into a little bit more advanced strategy tonight, but we're going to be covering how to use EMAs more effectively in the market because they're a heavily underutilized tool. Many people use moving averages, but they don't necessarily use them correctly. So we'll be having a look at that. We'll then be taking a look at key price action signals to be looking for and how we can use those with moving averages. I think that's a massive tool, bringing those two together. How to define a few candles and wicks. So candles, wicks, what we're looking for. We'll take a bit of a deep dive into that. And of course, calculating position sizes. We get asked this a lot, don't we, Tyrone? And it's often not understood what position sizes really mean. So we'll be having a quick look at that at the end. And then, of course, our Q&A. So if anybody has questions, please feel free just to pop those questions in the window at any time during this webinar, and we'll try to get round to either answering them during the webinar or at the end, we'll try to answer as many as we can. So that should be good. So just to get started, a few housekeeping, I guess, things that have happened at Pepperstone. Like last week, Pepperstone introduced some tighter spreads on indices. The NASDAQ has got one of the tightest spreads available. So if you follow your indices traders out there, you should be pretty happy with that. And we've got an extended trading hour sessions for most indices, except for the NASDAQ. And that may be coming soon as well, I believe. Is that right, Ty? I think it's coming soon as well.
It is, yeah, it's coming soon. They haven't actually set a date for that, but it is coming up. So we'll certainly keep you informed on that one.
Okay, so let's take a look at what swing trading really is. So today's obviously about moving averages and stuff, but I think that swing trading is really one of the best intraday trading strategies. It's one that's heavily used, again, not understood necessarily, but why do we want to use it should be always the question. Swing trading really is great for people that live kind of busy lifestyles, I guess. If you work 9 till 5, or you work, say, even part-time 3 days a week or 5 days a week or 7 days a week, swing trading within a few minutes, if not like 20 minutes, 30 minutes a day, you can make many decisions that are going to set you up for some great trades during that week. So we actually we actually love swing trading. It's one of our favorite types. It's probably the one that I guess we cut our teeth on back in the day. We started scalping, then we moved up the time frames, moved into swing trading, had a lot of success there, and then moved on to even the longer term trades. So Tyron, I mean, what do you think about swing trading? It's pretty good, isn't it?
Look, it's the way that you're going to be able to have a lifestyle and actually, trade at the same time. Like a lot of people want to be traders, and they want the lifestyle to suit. A lot of people decide they want to trade because they want to change of lifestyle and they want to work 9 to 5. But initially, they end up starting out and spending 10 or 15 hours in front of the computer screen each day, which isn't really conducive to actually good trading anyway. The beauty of swing trading is to give you that opportunity to trade for a couple of hours a day, if you want to, and approach those medium-term timeframes that could potentially go out for 2 or 3 days without having to be stuck to the charts. Like, you don't want to be in a position where you're a slave to the screen, which is what a lot of people end up doing at the start, because they feel they have to be invested. And it's not a bad thing to learn, but it's certainly not where you want to be moving down the track, because that's my idea of a lifestyle change. Being a trader is not being in front of the charts 10 or 15 hours a day and having all of the stress that goes with that sort of action. So definitely swing trading is probably the place to be for the majority of professional traders, really.
It's also, yeah, it's about slowing it down. I mean, I think one of the things that we often have to get people out of the mentality when they begin trading is they kind of often say to us, oh, trading's a bit boring right now. The market's a bit boring. There's always opportunities in Forex, and there's always opportunities in trading all of these different pairs that we have access to nowadays. But you'll be finding that when you get into swing trading and you understand the movements of the market, you don't really find it boring. You just don't see opportunities at that time. So yeah, I think it's a great way to start, and it's also a great place to really start building out your system and building out your success. And you're going to have less trades overall, but they will be generally of a higher percentage and a higher caliber. So really want to be typically following the trends of the daily and 4-hour charts with swing trading, and of course less transactions, but often high quality trades. So one thing we talk about all the time, Tyrone, is the top-down approach. And that's where we start with the highest time frame that we are looking at and then work down. And that helps us recognize a trending or range-bound market. And it also helps us to identify, I guess, key zones and zones that we would then want to set, let's say, mobile alerts or potentially email alerts for. So with swing trading, we don't have to be sitting in front of the charts, but we can get a mobile alert. The text says support broken. We jump into the charts, make our decisions based on our analysis that morning, and then start placing our trades in the market. So that's really, really great thing to do. You also want to use line, bar, and candle charts. So let's actually jump into one of the major currencies right now and go through, I guess, a few different things or a few different ways that the market might look to certain people depending on the type of chart they use. So let's load that up now. Let's actually load up here, and we'll just do a line chart to start with. So this is actually, Tyrone, and my favorite type of chart to start with, and that's because it really smooths your support resistance lines. So Ty, I mean, do you want to walk through? I'm just going to line up some supports and some resistances that are pretty clear here. Do you want to talk more about why we love line charts? I mean, something we didn't use at the start, did we?
No, that's right. No, it was certainly something that, yeah, we didn't really take advantage of, but we can't really emphasize enough how important it is. And we will highlight a few of these situations where this is a really beneficial way to analyze the markets. And a lot of people are actually unaware that it's actually available too. So, I mean, I'm sure for the most part, if you're using MT4 especially, it's very obvious where the line chart is. But a lot of people don't realize that it's actually, when it's in its generic state, it's actually set to the closing price, which is why it's so smooth. So you can see here, even with the lines and the highlighted areas that we've drawn, what we might do is actually put this back to a candle chart now, and we actually can see the differences and how much more difficult it would have been to actually draw that. If we blow that out, you can see how a lot of these candles and bars actually protruded past the support and resistance lines that we've drawn here, that aren't as obvious. And you wouldn't be drawing these in these absolute key areas if you didn't go to the line chart first. But now you can see that actually it's actually the wick action that's outside of these boundaries that we've drawn mainly, which is actually the important part, because that's where we know that the outlier of the price movement's going to be. That's why that's where the line chart really comes into its own. It's very, very important to do your analysis on that one first, because it really gives you the smoothed out view, almost like a moving average.
I'm going to actually load up this chart because I always know it's a weekly euro, and I always know it presents a very different look on the line chart. So you can see here with the closes, we've got some pretty key support and resistance zones, particularly this resistance up here. See how that's really smoothed what you're looking at in terms of the market. Now we switch that over to a candle chart. Look at the amount of times it breached. So the closes never breached, but the actual during that week it did breach, and it looks very different, and it can sometimes confuse traders when they first start. And also it's just great to see the closed prices, because that's where the market psychology was at the end of that that period of time, and that also means that there's a reason why it probably went back to that price. So see here, we saw the rejection come through, and then there's no coincidence that next time when it did break through, it was a fake out, and then end up creating a really nice shooting star candle here, and then of course rejecting all the way down. So this was like what a trap that you would see in the market, where the bulls thought they were in control, or a lot of people would have got hyped during this week. I still remember it very well, like we do with many of our trades. And then by the end of the week, the confirmation came through, shooting star candle. That's a very bearish signal off that resistance, isn't it, Ty?
It is, no, definitely, and it is really highlight. Look, you will find that you will remember some of your bigger trades, especially when it is over a weekly period. But look, we can't emphasize enough. Always go back to the line charts to do your initial analysis, and then the candles and bars will make quite a lot more sense because you'll start to understand the price action around that.
Okay, so hopefully that makes sense to everybody. Bars are also really important. It actually teaches you a lot about who's in control after each period. So if you haven't really, we won't emphasize bars too much today in this webinar, but if you haven't looked at bars and you haven't looked at what they mean and the closes and opens, yes, they're very similar to a candle. Of course, the candle's just filled in version of it, but you should learn bar charts as well and learn the psychology behind it, because a lot of big traders, they'll use either one exclusively or they'll use a mixture of these to make their decisions. And having more is always better, isn't it, Ty? The more reasons you can get into a trade, the better it is.
Oh, definitely. And look, for those of you who are wondering, I mean, the information that makes up a bar is exactly the same as the information that makes up a candle. So you're using open, high, low, close prices. But the one thing that I find, and this is why bars are important, because it doesn't give you a bias. If you look at a candle chart straight away, all you're going to get is basically a color, and you're going to say, okay, green candles potentially are going to be long, red candles are going to be negative, and you can be sort of seduced a little bit into thinking that that sort of approach, you're automatically just assuming, okay, red is negative. You're not really looking at the price action. Whereas when you're actually breaking it down to a bar, even though it's giving you the same information, you're not really being, I guess, exposed to a color of what the candle actually is. So you're not getting an automatic bias as to whether it's a negative or positive candle, which means that when you're looking at the bar, you're actually analyzing the bar for what it is. You know where the market opened and where it closed, and you're actually treating that bar in isolation rather than just making an automatic assumption because of its color. And that's why I think it's a really handy thing to look at, because it does really give you that insight to force you to look and think about actually where price actually did move, where it opened, where it closed in that, rather than just being seduced by the color of it and just automatically making an assumption that it's a long bar or a short bar because of its color.
I think it was a big game changer for us when we started using bar analysis better as well. It really does make you understand the market, and even just this multi-time frame, understanding candles and how they look on each time frame is very, very important as well. So let's talk a little bit about multi-time frame analysis and why we use that top-down approach. So on the daily candle, let's say we had this bullish looking candle here, and then we switch to a 4-hour candle. Yes, it's a bullish candle on the close, but how did it form that candle? And the reason why that's so important is when we look at this next time frame. So again, this is a 15-minute candles or periods on the left-hand side, and then we've got a 4-hour candle here on the right-hand side. And you can see, while this one does look bearish and it looks like it ended lower, the 4-hour candle tells us a different story, and that's a shooting star type of candle. And if you don't know what a shooting star candle is, you need to look it up straight away, just like a hammer. It's a very bearish type of candle, and it presents a different picture. So if you're just sitting there on a 15 minutes saying, oh, it looks kind of short, but I'm thinking of buying it, maybe under here at some support, and you didn't see this 4-hour candle, the bigger time frame is always the superior time frame generally with the overall what's going to happen in the market. That's where more people are going to see it. The bigger traders are going to see it. And we can definitely tell you that the biggest traders use those daily 4-hour weekly type of candles. They just do, don't they, Ty? Forex, stock, indices pay a lot of attention to the bigger time frames.
Oh, definitely, because the bigger the time frame is, it's actually the more that price action and people are actually seeing it. So, I mean, if you're looking at a 15-minute chart in the middle of the Asian session, all you're really getting is the Asian session people looking at that chart. But when you look at a 4-hour or a daily chart, a daily in particular, you're getting 3 of the world markets having their say in what's happening to that commodity, currency, or indices. So you're basically getting all of that information for a whole day, as opposed to a 15-minute chart where you're only getting a very small window. So the bigger the time frame, the far more important the information.
So the next step we want to do, and we will be jumping back into the charts and showing you a few examples soon, guys, is that you want to look at the timeframes you want to trade. So in this case, for swing trading with EMAs, we'd probably be looking at a 1-hour, 4-hour, and daily chart. And we'll generally find around 3 to 5 good opportunities per week with a selection of around 10 to 20 trading pairs. So trading pairs would be things like Aussie US dollar, Euro US dollar, Euro yen, those kind of ones. We usually like to select, I guess, the blue chip of forex currencies, so those large majors, and they're a great place to start rather than starting with some of the more exotic pairs. And that's just because these ones generally technically trade a little bit better. So if you're a technical trader, always think about the pair that you're trading and generally try to trade the bigger the better, usually with those things. You can also consider backtesting all of these strategies and the strategies that you use with swing trading on MetaTrader 4, 5, or CTrader. And of course, you want to spend time learning the way the market moves, time of day, how the currency reacts to different news events, all very important things for you to do. So let's talk about the averages, or the moving averages, and the basics behind them. So we've obviously got two here moving averages. We've got the slow moving average and the fast moving average. Ty, you want to talk about why we make the fast moving average, in this case red?
Yes, because it's well renowned that red cars go faster than any other color. So it's a very, very easy way to make that.
Lamborghini owners will disagree with you on that one.
Well, maybe that's true, but a lot of people associate red with the faster moving average, and really, it's just about understanding. In the first sight, as soon as you look at it, you know that the red is the faster moving average, so you don't have to think about it. Of course, once you've been trading for a little while, like you know the colors of your moving averages, and you know exactly which one is what anyway. But we always found, for some reason, this is how we started, and we've always made the fastest moving average the red one. And straight away we can see, and look, there's another reason why we use EMAs. I know we've highlighted EMAs as the main topic of discussion because we're talking about swing trading. EMAs move a little bit faster than SMAs because they're using a little bit more of the actual price action that's happening now to actually base their number on, rather than a smooth or a simple moving average, which actually uses the average of that. So to give you an example, if you're looking at a 20 moving average, an SMA 20 moving average is going to use it's going to basically be the average of the last 20 candles. Whereas the 20 EMA, which is the exponential moving average, uses the front end of those 20 candles that give a lot more weight to that moving average plot. So it's using, for instance, it gives a lot more weight to the last candle, the second last candle, third last candle, compared to the 20 candles ago, 19 candles ago, and 18 candles ago, which means that it's obviously a little bit more reactive to price, which makes it a little bit faster. So when you're using moving averages as a trading system, or if you're trading crosses of EMAs on the smaller time frame, so the 5, the 8, and the 20, you're better off using the EMAs because they are giving you a little bit of a quicker response, so you are able to get in and out. Now, the drawback, of course, with that is sometimes you're going to get a false signal because they are a little bit too quick, and they can give you a potential false breakout. But we found that for the most part, when you are scalping or swing trading, entering off the EMAs, for the most part, they are going to be quicker to get you in, and you're not going to get as many fake outs as you probably think.
Yeah, I think EMAs are a pretty good tool, especially on the lower moving averages. So things like the 5, the 8, the 20, the 50, the 100. The 200, sometimes we use the SMA because it's quite heavily used in the markets, and it's just something that I guess I mean, either are good, aren't they, Ty? But I mean, we do tend to sit on the SMA a little bit on that 200. But these are some popular ones. There are reasons behind it. We won't go. It's meant to be a bit more advanced tonight, so we won't go into every reason why. But there's some great starting points for your charts for sure. Okay, so let's jump again into the market, and then let's talk about the moving averages. So I've got a few here. I've obviously got that fast one, which is the 20. I've got the blue, which is the 50, and then I've got the green, which is the 200. This is what we use. We like these colors. I think they're pretty good. I mean, we've been using them now for decades, so we're pretty big fans of these ones now that I think about it. But it's a few things that I guess you always want to think about when you're trading moving averages. So trading moving averages by themselves, if it was a successful tool by itself, it would be quite easy actually to set this up into a robot, and therefore have robots that trade every time certain moving averages cross. The problem with that is it's had a lot of fake outs and they won't always work. So what you want to do with your trading system is you want to use moving averages or any indicator alongside other reasons to be in the trade. So I've got here the New Zealand CAD, and it's a little bit different to, I guess, the traditional currencies you may be looking at. But you can see here we've got some resistance. got some further resistance, got some resistance here. We've got a cross of the moving averages that happens here, and we've got that really nice support line that's here. So we've seen a cross, and then at the same point when the market breaks through, it also breaks through that 200 moving average. And that's really key for a great trade. You've got moving average cross, where the fast one has crossed under the slow, and then you've also got the 200 moving average on the daily, which is such a significant moving average being crossed against as well, as the support has been broken on arguably a pretty nice resistance sell-off. So things like this bit here, where the market has come back, tested this zone and done something called roll reversal, is going to be a very high quality zone for you to look at trades. And this could be a 15-minute chart or a 4-hour chart or anything like that. So if you were, let's say, seeing the market down here, if you thought the market was still going short, which you probably should at this point, this would be a great point to target a reload or an entry point, wouldn't it, Ty? I mean, it doesn't get much better than this.
No, it doesn't get much better than that at all. And this is why, and this is probably another reason why we actually use the SMA on the 200, because it's less important for the speed, and probably more steadiness is actually the key for it. And really, when you actually, if you put an EMA 200 over the top of the SMA, it wouldn't make much difference on the 200 anyway. You'll find that it actually isn't as significant a move as the smaller time frames. But in terms of using moving averages for an entry point there, it does not get better than that. That is just perfect.
So let's think about the dynamic resistance we have here. So we've confirmed that the trend is down. The moving averages have crossed. They're actually widening at this point, we can see. And we can see also that the price has moved under the 200 moving average. But on top of that, the support has been broken. It's a roll reversal zone. We've got the Fibonacci retracement showing a 38.2, which is one of our favorite Fibonacci retracement levels. And then you've got dynamic resistance, because the moving averages act as resistance or support as well within a trend. So you can see here the 20 acted as resistance. The 20 tried to act as a resistance, failed and came through. And then of course this was just too much. This was the best zone you could have been involved in. And then all of those things happened.
It doesn't get better. As a technical analyst, that our Pressix scoring system, which a lot of our traders use, that scored one of the highest scores we've had this year. This particular trade, that was just I think it was over 350. So yeah, it doesn't get better than that. So as an analyst, if you're looking for those opportunities, whenever you see them, you must take them, because they very rarely fail. And when there's that much backing up what you are really looking for, that's really a very simple concept. That's roll reversal with moving averages with a confirmation of a candle. It doesn't really get any more basic than that, does it, Thomas?
Not really. I mean, it's all about, I actually love using patterns or swing pattern breaks with maybe reversals into it. So let's say like here where we've got this double bottom break and it breaks up, and then a few candles after the moving averages cross. Imagine if this had come down and tested this point here. So at this point, it would have come down, tested. At the same point, this was acting as, well, was resistance, now will act as support. We would have the moving averages acting as dynamic support. Alongside, we had the cross, which gave us a confirmation. We had the double bottom, so we knew that the distance should be at least that, and therefore it would go up into that direction. And it definitely went the full distance of the double bottom. But on top of that, we could be saying, okay, we might get in here and buy some here because the confirmation had happened and the pattern sounds good, but the swing here is even more powerful. So I think a huge part of tonight's webinar, if you're going to get anything out of this, is that if you see breaks of strong resistance or support lines happen, and then the swing occurs and it comes back down, think about where the moving averages are as well. Do they act as dynamic support or resistance? Because that can give you extra points and extra safety for your trade. And a big part of our Pressix system that Tyrone was talking about is we want to make sure there's actually not too many things against us, so it doesn't need to go through too many resistances and too many dynamic resistances. And we want to have as much dynamic support if we're buying or dynamic resistance if we're selling.
Yeah. Now, one thing to note here. Now, yes, this one didn't come back, and I guess people would be wondering, well, what happens when it does blast through that and basically doesn't come back? How do we actually get into this trade? Now, you must remember that we're on a daily chart here. So this euro pound is on a daily chart. So when we go and
But one thing I
can
want
we
to
just
do,
we'll go back to the
I know
daily
what
there for
you're
a
going to do.
second.
Yep.
Yeah. So we're gonna draw that zone there, and then what we're gonna do, we're gonna go back to a 4-hour chart, or even potentially a 1-hour chart, and you're gonna see that although the price did break through and didn't look like it was going to come back, it did actually come back on the 4-hour and actually test that line again. And we know that line where we've drawn here, the 87, 88 line, that is where the 200 was when it came back. So as much as price blasted through on the daily, right where that line is, right there where our marker is here, we're highlighting this area here, price did break through over the 200 on the daily chart and come back and test it. So you will get, and this is why we always say the top-down approach is always the best, because we're getting our initial idea from the daily, but then we can do our entry points and our location and entry points on the 4-hour or the 1-hour charts, because they're the ones that are going to give us the clues as where the market has actually pulled back to give you that point of entry. It doesn't look as obvious, anywhere near as obvious on the daily, but all the daily has given us here is actually the direction of what's going to happen. Once that's happened and we've got our directional bias, we're going to move down the smaller time frames to actually get our entry point. And it doesn't hurt to highlight where those levels are on a daily chart, because we know where we've got this yellow T drawn is exactly where the 200 moving average was on the daily chart. So it interacted with it. It struggled to break through for 10 or 15 candles there. Then eventually did break through, came back and gave you 3 opportunities to actually enter this trade before it went off and continued on its higher high and higher low trajectory.
Yeah, there's a lot of different trades here. I think, as Tyron alluded to, this is definitely a great trade. Break of this is also a great trade because you've seen that consolidation above the
Well,
200.
that's actually, I mean, you'd argue that was actually an ascending triangle. I mean, you could make an ascending triangle out of that one, of the break there.
And it's a big thing we speak about. It's all about, I'll see what his Tyron's talking about is basically a bit of this above, which is what you often see inside of trends. And that's what you want to be looking for. You want to see, okay, we've identified the daily breakout. Let's now either look for opportunities on the daily, or let's look for opportunities on the 4-hour, 1-hour, and the swing. So when it swings back and tests things. So this is a good little chart to look at, but we'll actually have a look at a few others now. Let's talk about, I think there was a very aggressive one recently, which was the pound yen. So here we had the daily break out of an incredibly strong support zone. Moving average cross happened at the same time. We see this. Ideally, we would, of course, want the market to come back up and do a bit of a role reversal and then come back down, but it doesn't always happen like that. So you've got to be ready for all the different scenarios. So one other thing you could do is you could say, okay, well, how is the market reacting? The market's gone incredibly strong, and then it might be coming back and testing potentially one of the moving averages. So sometimes what you'll see is the market will actually test maybe the 50 moving average here. This is a great little entry point. Look at this. We can move over to the candles. Very strong rejection off the 50 moving average. That's kind of what you want to be seeing. Maybe you missed out the start. You see this though, it's on the point of a role reversal within the trend. You can see support becomes resistance. Great rejection. Potentially get involved on the trade here and then ride that second part of the trend down. And that's what you want to be looking for. You see stuff like this, that's a massive kind of tick in your favor because you've identified the role reversal, you've identified a strong rejection, you've identified the moving average acting as dynamic resistance. And then on top of that, you can probably go back to one of the other time frames and what do you know? At the same point that was happening, check out this, Ty. I mean, this is what makes me or Tyron and I very excited about technicals, because you can see that the support over here, which was once in the past, and even the support over here and the support over here and what ended up being resistance, acts again as a dynamic resistance zone. And that's the same rejection that we were looking at on the 4-hour. So top-down approach, so important, just so important.
Yeah. These levels, we can't emphasize enough how important it is to draw key levels with lines that you'll understand, because, and this is, the top-down approach is just so important. And like I said, to us, this is just so easy. I mean, it looks so easy, and I know we're explaining it like probably, everybody should know it, but once you've done it enough times, you'll see these things happen all of the time. Like you'll see these setups all of the time in all markets. So once you start putting the process in place and you start looking for the right things, these opportunities, and this is what we said earlier in the webinar, the opportunities are always going to be there, and there's many of them. So you only want to be taking the quality trades, okay? Because at the end of the day, there's plenty of quality trades to be had. You've just got to know where to find them. And the moving averages as dynamic support and resistance are a fantastic way, especially if you're first starting out. And even if you're not starting out, even if you want to use them as your anchor for your trading strategy, they're not gonna let you down. And we can see here again, like we probably didn't highlight the fact enough how the 20 moving average is probably our favorite for re-entry zones on aggressive trends. So when you do get an aggressive trend and it's not coming back and testing other moving averages, the 20 is your go-to re-enter. So when it does come back and touch the 20, it's usually the time that you can actually join that trend. You can see how aggressive, even aggressive ones come back. You can see, all the way back in July the 2nd, 2018 there, it started touching the 20 and it started working its way up. It touched it 2 or 3 times and you're getting really big moves off that. So yeah, in an aggressive trend, when the price is making higher highs and higher lows, you're going to quite often find that in an uptrend, it's going to the higher low will touch the 20, and in a downtrend, the lower high will touch the 20.
So just to break down this one, we had a break of this trend line. Now let's just say you weren't comfortable taking it off the break. That's totally valid. But when the moving averages cross as well, that should be a signal of, okay, well, we've got the break at the trend line. That probably means that at least the short-term downtrend is gone now, and it's maybe an uptrend. Then we've got the moving average cross here, and then we may have missed out still, but guess what? The swing trading method gets you back in. You could target this area, potentially jump down into the smaller time frames, like we're saying 4 hour, 1 hour, start looking at those, start finding reasons potentially to be in there at those points. So highlight that zone. Maybe it was on the 1 hour for us in this case. I'll have to see if I can get back through time, because the 1 hour is quite a lot of candles away. I think it was here. And oh, there you go. You've got a nice little inverse head and shoulders here on the 1 hour. That should be around the right time. So you've got that left shoulder, head, right shoulder. It's definitely an inverse head and shoulders. Now, in this case, the inverse head and shoulders is its own trade, and you can see the conservative entry also got you in as well as the break.
Maybe we should draw that one for everybody, Tom.
Absolutely.
Yeah. It's a really great example, because actually we can go back now and we can see that this inverse head and shoulders was actually at a previous level of support. So it wasn't just, it had a lot more reasons than just an inverse head and shoulders, but it played out quite nicely. And it came back.
We didn't know that was there either. So it does really show that this is what we're looking for, though. Notice how we went daily, 4 hour, 1 hour. When we analyzed that area on the daily, we would straight away jump into the 4 hour and 1 hour, because we've seen the moving average. We know that's dynamic support. We know the crosses, everything's happening. We jump in. Let's find a reason to get involved in the trade with price action. There it is. There's our reason. Moving average crosses soon after through the break. Even if it comes down and retests here, remember our stop should at least be behind here. And you could actually have had a incredible success on this trade, Tyrone. I mean, this is where dreams are lost or made, but I'll tell you what, it's a pretty serious kind of trade. Imagine if you picked it up on the roll reversal. We had that 30 kind of pip stop here, and you know that it's good for more than the inverse head and shoulders, because in this case, you're actually looking at a daily. So maybe you take some of your money off at the inverse head and shoulders full completion, and then you leave the rest on. And it's not a pipe dream to think that it's going to go higher, because you've done that top-down approach. You've basically said, okay, what's it doing on the larger time frames? Where is it? And then you've traded off that point. So you've traded to the long side. So yeah, I love that type of trading. It's great.
That's what trading's all about. Look, at the end of the day, that's it really, if you're going to put it into a nutshell, it's about working out where the trend is going on a bigger time frame, finding the entry point on the smaller time frame, and getting enough evidence to go in your favor. Done. Risk management, trade done, go have your coffee.
Or your tea if you don't like coffee.
Well, or your tea.
Okay, let's jump.
We don't oversimplify. I know we're probably oversimplifying by that, but truly, It really is as easy as that. A lot of people seem to think they need to do a lot more analysis and that they need to go into fundamentals. They need to go into, there is a place for all that, but that's generally in the longer term trading. Like, fundamental analysis is not going to do a lot of good when you're scalping.
No.
And it's certainly not, and even to a lesser extent, swing trading for a day or two. So it certainly has its place. But if you're looking for, your moves of 50 to 100 pips, or you're looking for these patterns to play out, the most analysis you have to do is the technical analysis we just talked about. You don't need to overcomplicate your screen with too many indicators that you don't probably even understand or anything like that. If you understand price action and you understand the basic indicators, that's all we do, and it works very well for us. So there's really no reason why you can't translate that into successful trades. Keeping it simple is probably one of the things that we took the longest to learn. When we first started, I can assure you, if you looked at our charts, you would have struggled to see where the price action was. We had tried every indicator under the sun, most of which we didn't even know, what or why they were working. But as beginning traders, we tried all that. And now what you're seeing on your screens is where looking at MACD or those simple moving averages or the EMAs that we've got on. That really is summing up what we actually see. We don't have any key indicators that are different to what we're actually showing you on the screen.
So Fibonacci retracements are a great way of also adding extra, I guess, confirmation to your swing trading. 23.6, 38.2, 50, and 61.8 are the general Fibonacci retracement sequences. Tyron and I believe that, I guess we really love the 38.2 and we love the 50. And it's got to do with human psychology, really, why we like those. If something comes back a third, generally people are super keen on it. And I think the easiest example has been cryptocurrency, at least during that massive hype train to when it started going down. So I remember it hit Bitcoin hit like almost $20,000 a coin, I think. And then it dropped, and at $16,000 a coin, everyone thought it was awesome. Now at $10,000 a coin, people also thought it was awesome. But then they didn't necessarily think it was as great when it dropped under that 10,000 number. So if we think of, let's say, the run from 0 to 20,000, let's say that was all one big move, which it kind of was because it went from 1,000 all the way up. When it comes back, the psychology of people is that they are prepared to buy in up to a point. And then when that point has gone too far, and I guess that would be the 61.8 in this case, the trend is over and it's in the new trend. So in this case, it would be in a bear trend. I think that the 38.2 and the 50 is good for a healthy trend. And 61.8 is a little bit far back. So Tyron and I are a little bit different to what a lot of people believe out there, but that comes down to human psychology. And you've got to think of things logically, don't you, Ty?
Oh, definitely. And it really, trading is a logical sequence of events. So you really need to apply the same logic when you are actually isolating trades, because it's like no other, well, it is like every other business. Logic does win the day.
Now, I've got a question here from Giuseppe, and he asks how much importance to give on dynamic support resistance of the smaller time frame moving averages. He understands, obviously, the larger ones will override, but how much value would you put on the moving averages on the smaller time frame? I guess in my analysis, I use it more to give me confidence in the trade. So I actually really like starting the basis of most trades on the larger timeframes, because that's where I know the bigger money is and I feel more confident in that. It's all about having confidence in your trade. And then, like we saw with that example with the inverse head and shoulders, Giuseppe, what I would do is I would say, okay, when that inverse head and shoulders, the moving average of the 20 and the 50 cross, and then it comes down, it hits that support, I'm going to be pretty comfortable with that, because that's going to act as, some dynamic support. It's going to give me that confidence. And then when it breaks through, let's say the 200 moving average on that smaller time frame of the hour, that may then act as dynamic support, etc. And I expect also it may be resistance. So it's really just more, I find it as a great confirmation piece. I mean, Ty, do you think anything differently to that?
Yeah, it is. And I think you can also use them to actually really outline what you're trying to achieve. So, I mean, when you're using a smaller time frame, say a 5-minute chart or a 15-minute chart, and you're using that moving average specific to that chart, so a 10 moving average or a 20 moving average, you're only going to really get support on those moving averages or resistance if you're going down, relative to what you're trying to achieve. So you're not going to take a touch of a moving average, say a 20 moving average on a 5-minute chart, and expect that it's going to go 200 or 300 pips in your favor. Like, you're probably, if you're trading a 5-minute chart or a 1-minute chart, your expectation of that trade is probably going to be a lot less than it would be on a 4-hour chart and a 1 hour or even a daily chart. So I think it comes down to the expectation of the trade as to how much reliability you can place on it. But that said, if you're looking for an extended move of a head and shoulders or an inverse head and shoulders on a 5-minute chart, and you get support off a 20, that's going to give you as much support as you need as it would if it was on a 4-hour chart or a daily chart. It is completely relative to the time frame that you're looking at.
So I think step 3, I'll answer your question in a minute, Hussein, but step 3 is optimize your entry. So you want to enter based on confirmation, not on gut feeling. Talk about it all the time. Have a business plan for your trading systems. Don't break even trades with fixed pip amounts. Use percentages. I always go on and on about this because it's just a common mistake I see. Make sure you use percentages in your trades. If you say I always have a 50 pip stop loss, or I always break even my trade at 50 pips, that's a recipe for disaster, and every new trader starts that way. Oh man,
yeah.
we did it. A lot of people do it. It's bad. It's really bad. So think of it as a percentage based system, not fixed pips, because the market doesn't care about your fixed pips, that's for sure. And of course, spend time learning the way the market moves. I think the market is more probably 24/5 and a half than it used to be, Ty. When we first traded, and we did this a long time ago, the Asian session was very bad, very bad. Spreads were 20, 30 pips for the pound yen. It was some wild times when you think about it to where we are now in trading. But yeah, you should still learn the way the market moves. If you're trading the Asian session, expect things like the yen pairs to be moving more than they would maybe necessarily during the night. And of course, the European session, expect the pound and the euro to be moving. So Hussein had a question about how do we use Fibo levels for entry on trades? Do we use it similar to EMAs? Yeah, we do. I mean, I think role reversal is probably what you want to look at here, Hussein. If you have, let's say, a Fibonacci, and you drew a Fibonacci from, let's say this was the swing low, and you drew that from the swing low to the swing high, if the Fibonacci level is at this where resistance becomes support, role reversal area, and there's a 38.2 fib here, then that is going to be a great zone for you to target, because a lot of Fibonacci people are going to also be trading that. So with fibs, what we like to do is we like to overlay them with support resistance or with moving averages behind them as well. So we like to use them as kind of like a confirmation tool that that's a great level. So in this case, if we took our fib from the swing low to the swing high, this was a 23.6 or a 38.2 fib, probably be a 38.2 or maybe a 23.6 actually, then that would be a strong level because we had previous resistance which became support. So very, very nice level. Step 4, with all of your swing trading or intraday kind of trading strategies, you want to be targeting higher R multiples. If you're a swing trader, try not just to go for even 1-to-1s, but definitely do not go for 0.8 and 0.7 to 1s and those kind of things, because then you need way more successes than of course losses. Now, one thing I see people do way too often, I had a guy call me today, and I hadn't told Ty about this, but he told me he's been trading and he had 30 wins in a row, and then he has one bad one and he loses his whole account. And I said, well, that's not possible unless you're doing the one thing that everyone seems to do, which is no stop loss, Ty. What do we think of no stop losses?
Well, if you're not, well, it's going to be very, very difficult to have a consistent strategy and use risk management. Well, there is no risk management if you haven't got a stop loss. So yeah, it's going to be a very difficult road. Let's just say that.
Okay, we also want to be looking at, of course, good looking trades will not always meet your criteria. And of course, practice discipline is very, very important. Here's just an example of maybe what a swing trading system might look like with some moving averages and other things. So you might want maybe 3 of these reasons to be in a trade. And if you have those 3 reasons, then you can place the trade. And I think that's very important for everybody to do. great thing to do if you're a bit old school like us is maybe print your trading system, laminate it, just tick it with a texter. Makes it more real. The one thing about computer trading and forex trading and everything is it's not necessarily like, you don't feel like it's real money. I find a lot of people struggle with. So even just having your trading system as a real physical thing in front of you, it helps a lot. It really does. What I will be doing as well, I've got a few questions here that I guess we can answer later. We will be wrapping this up shortly, so hopefully you guys enjoyed tonight's session. But we will be doing a session straight after this, so I'll actually put that in the room now for anyone that'd like to attend. So we're going to be running one of our webinars. We run that kind of live market, bit more analysis in the charts. But I think it's a good lead on from tonight's webinar. We've gone through some of the theory. We just get straight into the charts on that one. So if anyone's interested in attending, you're welcome to do so. I'll send it out to you now. One second. Tyron, anything else, I guess, while I'm doing this that you'd like to mention?
No, I think just we've got Pressing on the screen. This is our trade management system. So it works similar to how those points were accumulated on the previous slide. We allocate points to all of the different sections of the Pressing system. So look, we talk about that a little bit more in our webinars. If you do jump in later, we'll give you a link for a video that you can watch on how that system works. But it really comes down to the planning of it. If you plan your trades well and you use the right evidence that we've talked about tonight, that's with rolling moving averages, with roll reversals, and pattern setups on the smaller time frames of the direction that you're looking at. That really is coming to set up a plan for the trade. And a system like Pressing, or what we put on the screen earlier, really just makes you accountable for what you are actually looking at. So it takes out the fast transaction speed that you can sometimes do on a platform without giving it the analysis that it deserves. So it's quite important to have a plan.
Okay, well, I think I answered a few of the questions. If anyone does have other questions, though, please feel free to come to our webinar after this and we'll answer those. But hopefully everyone enjoyed, and hopefully you're starting to get a bit of an idea of what it takes to, I guess, take your trading to the next level. Remember, it's about finding as many reasons as possible to be in a trade, and patterns or price action followed up with things like swing trading, Fibonacci retracements, and moving averages and roll reversal. Boy, oh boy, is that the place to start. If I could go back in time and start right there, we definitely have made it a lot faster, wouldn't we, Ty? I mean, we love this style. We just love it.
Absolutely. No, it makes a massive difference. So.
All right, guys. Well, hopefully we'll see you soon, and hopefully everyone enjoys. And yes, there will be a recording of this on Pepperstone's website and also Pepperstone's YouTube channel. So if anyone would like to go and subscribe to that, just search Pepperstone YouTube in Google, or just go to YouTube, and you can always check out our after recorded webinars, which is awesome.
Great. Thanks for joining us, guys, and have a good night.
See ya.